Most of what you're seeing in the price charts right now is noise. However, underneath it, the world is being rebuilt and is being rebuilt in two opposite directions at once. AI, we know, is displacing labor and will do so more so this year, concentrating power and giving governments tools of control that have never existed before. And simultaneously, at the same time, almost unintentionally, the infrastructure for a genuinely open, decentralized, sovereign, meaning giving you freedom of your own money, is maturing in real time as well. So the same forces tearing the old world apart are also funding the construction of both of these new worlds that I just outlined for you. And that polarity, that tension between total control and total freedom is the context for everything we're about to look at in today's video. And where you sit on that spectrum is ultimately the most important financial decision of our generation and of your lifetime. So let's get into it. All right, so here's the current state of the market. Bitcoin is currently sitting 46% below its October 2025 all-time high of $126,000, a drawdown that's been building for months. This week, it touched $63,000 before bouncing to $68,400, a $6,000 swing in 48 hours, driven by a short squeeze that liquidated nearly 400 million in bearish bets. Around 45% of all Bitcoin in circulation is held at a loss right now, meaning nearly half of all holders of all people bought their Bitcoin at higher prices. And at the same time, the Fear and Greed Index hit 5 this week, the lowest reading ever recorded, lower than it even was during COVID, lower than the 2022 collapse, lower than anything in this index's history. And yet, on that same day, US spot Bitcoin ETFs recorded 257.7 million in inflows, the highest single day figure in nearly 3 weeks. And we know institutional capital was moving in through ETFs at that exact moment that retail sentiment hit its all-time low. So we saw that price drop also reflected through the ETFs. Meanwhile, gold is at $5,080 an ounce, near all-time highs. And JP Morgan raised their 2026 year-end target to $6,300. And central banks bought 863 tons last year in 2025 alone. And we hear from the World Gold Council that 95% of central banks, the highest share ever recorded, they plan to increase their gold reserves over the next 12 months. Speaking once again to the risk, uncertainty vibe floating in the market. So we have a setup where 4 events happened this week that explain why all of this is moving the way it is. Iran, for starters, signaled it's ready to make a deal with the US, something I'm personally so happy to hear. And Europe committed to the biggest military spending surge since the Cold War, which is also good for the military industrial complex, whether or not we agree with it, because this means they're going to be buying more weapons, which ultimately has a really interesting way of stimulating the market. Well, as I covered earlier this week, the Supreme Court ruled against Trump's emergency tariff authority. And a Deutsche Bank report put a number on how close the world is to a fundamental shift in the global reserve system. Each one of these events technically deserves its own breakdown. Let me know if you'd like me to do this. But today, I thought it was important to at least lay all these events out on the table and do my best to connect how they're all connected in shaping the future we're walking into. All right, so let's start with the first force. That is Iran. We hear that Iran's deputy foreign minister said the country is ready to take any necessary step to reach a deal with the US. When that landed, gold pulled back slightly and Bitcoin bounced alongside equities because lower political tension means lower safe haven demand. People aren't as scared, which in turn means capital gets to rotate back towards risk assets in the short term. So that was the technical reaction. But the underlying dynamic has changed. The Middle East has been a persistent source of elevated risk premiums all year. The Israel-Iran conflict, oil supply supply route uncertainty, US Iran brinkmanship, every escalation bids up gold and pressures risk assets. And every de escalation, on the other hand, partially reverses it. The cycle continues because the structural instability hasn't been resolved. One diplomatic signal doesn't end it, though at least we're moving in the right direction. Next force that we must get into is Europe rearming itself. NATO committed to a defense spending target of 5% of GDP by 2035, a level the US hasn't hit since the Cold War. And the S&P Global Ratings estimates meeting that target would add approximately $2 trillion to collective NATO member debt by 2035. And then, of course, the Russia-Ukraine negotiations are still grinding. 3 rounds in Abu Dhabi, a prisoner exchange, yet no ceasefire. And Europe is building its defense capacity regardless of how those talks end, because the cost of being underprepared is now quite understood. And $2 trillion in new debt means $2 trillion in additional currency issued to service it. Currency issued against debt without corresponding productivity growth loses purchasing power over time. Capital that needs to hold its value across a decade of that environment has to move somewhere that can't be diluted. And then the third force has to do with the central banks buying gold. We know that central banks have bought over 1,000 tons of gold across 3 consecutive years. Poland approved 150 additional tons, targeting 700 total. And Kazakhstan, India, Brazil, and China are all adding as well. The Deutsche Bank report this week found that if gold reaches $5,790 an ounce, total global central bank gold reserves will surpass the value of their collective US dollar holdings. The first time a non-fiat asset would lead global reserves since the dollar replaced gold as the foundation of the international monetary system. And the reason is straightforward. When the US froze $300 billion in Russian foreign reserves in 2022, every central bank holding dollar-denominated assets learned those assets can be switched off by any political decision in Washington. Whereas gold can't be frozen. It has no issuer. It has no jurisdiction. That's the property they're paying for. And okay, here's the fourth force that's affecting the market right now, the tariff ruling. I covered this in greater detail earlier this week. I think it was Monday or Tuesday. But essentially what happened is the Supreme Court ruled this week that Trump's emergency tariff authority exceeded its legal basis. So basically they're saying he overstepped his powers. And I will link that full video in the description below. However, what's interesting is the ruling, by the Supreme Court didn't end the tariff posture. Actually, many countries came back, and Trump spoke about this in the State of the Union, where he said many of the countries, after hearing this Supreme Court ruling, decided that they would keep the tariff rate they had negotiated with Trump's administration because they just don't want to go back to the table and enter renegotiations again. Anyway, what also happened shortly after the Supreme Court's ruling is that Trump, typical, pivoted to a different legal authority within hours. And what I'm really getting to in today's video, what matters right now is the pattern that we're identifying, that I'm identifying. The US has been using its economic infrastructure, the dollar, the payment system, trade access, as a geopolitical lever. Actually, every nation does this, And every time this happens, it accelerates the incentive for other countries to hold reserves that aren't dependent on that infrastructure or not dependent on the dollar. That said, let us move over to talk about Bitcoin, because Bitcoin steps in as the alternative for many countries when looking for a different currency, a different reserve currency to depend on. Because even gold doesn't have a system in which to really prove that it is fully authentic. And it's really clunky to transfer. And if you want to ever redeem your gold, it takes a while. It takes several days, if not longer. So that's why many nations are looking to Bitcoin. But then you might ask, why is Bitcoin suffering so much? I thought it was the digital gold, right? Well, right now we have a situation where Bitcoin, and I also covered this extensively in past videos, but let me know if you want me to do a recap. Because right now, Bitcoin still trades like a risk-on speculative asset. It's moving with the NASDAQ. So when Nvidia reported 73% year-over-year revenue growth this week, Bitcoin bounced with tech. And when geopolitical tension spiked earlier this year, Bitcoin lost 6.6%, while gold, on the other hand, gained 8.6% in the same period. That correlation to equities is real and is current, and once again points to the lack of education or the learning curve institutional money and the world alike is going through in understanding Bitcoin's real value. However, for those of us who know, okay, Bitcoin maxis, for those of us who have been in the space for some time, have read the white paper, which I would encourage you to do. Also, let me know if you want me to do a video covering Bitcoin's white paper, which explains its value and how it works in really easy to understand words. Anyway, what I'm saying is that Bitcoin's protocol does not change, okay, based on how it's being treated. We know there will only ever be 21 million Bitcoin ever. And it's not a policy anyone can revise, but a mathematical rule. It's programmed and enforced by the network itself. No central bank, no country can authorize more. No government can instruct a treasury to issue additional Bitcoin supply. It's a non-sovereign, fixed supply and is permissionless by architecture, so it's truly free money. And what tells us that Bitcoin has a bright future is seen reflected in gold, because the same properties I just listed out for Bitcoin are the properties, okay, or qualities that central banks spent $300 billion equivalent paying a premium for in gold this year, because gold also allegedly, right, has a fixed supply. Though technically you could mine in outer space, you could mine asteroids and bring back gold. That's a separate conversation. I know people working on that, actually, one of my friends. But anyway, for the meantime, it has a fixed supply insofar as it pertains to planet Earth. Okay. And gold has no sovereign issuer, right? It doesn't belong to the US. It doesn't belong to China. So that implies it has no counterparty risk. Okay. No jurisdiction, no country can freeze it. Though technically, if they're holding it, right, in their safes, they can technically freeze it. So what I'm getting at is that we have a situation where the central banks, many of them, spent $300 billion on gold for its alleged scarcity and sovereign qualities. Meanwhile, Bitcoin has them in digital form and adds to these qualities programmability, borderless transfer, and a supply verifiable in real time by anyone. No one can counterfeit Bitcoin, whereas technically they can with gold. But this is why I say the institutions and the sovereign wealth funds of the world are learning about Bitcoin. So the very logic driving them to buy gold, okay, the skepticism of weaponized the dollar infrastructure and the need for reserves no government can control, and a hedge against currency debasement, because that's been gold's main purpose, is precisely the logic Bitcoin was built to address. So the market is pricing Bitcoin as a tech-adjacent speculative asset and gold, on the other hand, as a sovereign reserve asset. Does that make sense? Please let me know in the comments. Yeah, they share the same foundational prop, and that gap exists because institutional understanding and education of Bitcoin hasn't caught up to what Bitcoin actually is. And it's important for us to remember this. And one of the factors that would close this gap is regulatory clarity. The Clarity Act, okay, legislation establishing jurisdictional lines between the SEC and the CFTC for digital assets, and basically clarify to businesses and exchanges and banks and the everyday person on how they can handle Bitcoin, and if they even should. Because the minute the Clarity Act passes, it legitimizes it in everyone's minds. And the Clarity Act, this is what is so exciting, has a March 1st White House deadline to resolve itself. Because right now, we know that crypto exchanges and your everyday typical central bank, they're fighting over yields. But we see that prediction market odds sit at 47% after Trump omitted crypto from the State of the Union address that he gave a couple days ago. But Treasury Secretary Scott Bessent is signaling a spring timeline, and the Fair Shake PAC has $193 million ready for the 2026 midterms. Without that clarity, pension funds, sovereign wealth funds, and fiduciary-bound asset managers cannot allocate to Bitcoin at scale. the legal exposure for them would be too high. So while we may not have clarity yet, okay, if you've been following the news or you follow me on X, which I'll also link below, we know that regulatory infrastructure clarity is still coming along, and we should have resolution soon, as soon as next week. So, okay, as we wrap up today's video and everything that I covered, we know that Bitcoin has gold's core properties, plus capabilities gold structurally cannot have. Whether institutional capital acts on that depends on two things, both currently in motion: the regulatory infrastructure being built through legislation like the Clarity Act, and a macro environment that keeps making the case for non-sovereign, fixed supply assets more legible to the institutional managing the most capital in the world. Both are moving right now. So yes, the price chart right now may show a 46% drawdown and an all-time low in retail sentiment. But what it doesn't show is a $257.7 million in institutional ETF inflows on the same day fear peaked. Nor does it show 3 consecutive years of central bank gold buying consensus built around the same underlying properties that empower Bitcoin, that define Bitcoin. So it shows us the potential value that could flow into Bitcoin in the near future, especially once the Clarity Act gets approved, because it shows us a situation where the central banks understand, because they're very well versed and educated in economics, and the fact they've been buying so much gold across the last 3 years tells us that they see a world, they see a dystopian future, unfortunately, where the US dollar and all fiat currencies belonging to all the nations of the world going down in value because they have been inflating year after year, especially since COVID. So they're hedging against it and buying as much gold as possible. And those same reasons are not going to go away. The dollar is debasing itself more and more and more alongside all the other currencies of the world. So as soon as the institutions and sovereign nations start educating themselves more, as they're doing on Bitcoin and Bitcoin's inherent value, which is better than that of gold, okay? Where do you think that value, that through the 300 billion or so, okay, is going to roll into next? At least partially. I'd say Bitcoin. So yes, today I covered different angles, okay? But they're all running in parallel. And it's important to know that the market, it's not just this thing off in some random corner in some silo reacting all by itself. No, it reacts to the events going on in the world. And that's why I bring them to you. So right now, I believe we are living through a simultaneous construction of two financial worlds, one more controlled, more surveilled, more dependent on the goodwill of the institutions issuing the currency and AI, okay? And then the other, which is more open, decentralized, and mathematically, okay, programmably sovereign, where no one can change it. And the macro forces we just walked through in today's video are accelerating both worlds' developments. But they are also, okay, unintentionally making the case for the second one more legible and more needed every single day, which is ultimately bullish for Bitcoin, because Bitcoin is the money of the people, for the people, and not as a price prediction, but as a structural observation about which direction the pressure is pointing. I hope that made sense to some degree. Let me know if anything didn't make sense. Let me know if you want me to dig in deeper into any topic that I hit on. I'd be so happy to do that for you guys. I love you so much, and I will catch you here tomorrow. Take care.